Question 1. Which of the following is an example of a non-indemnity insurance policy? A. Health insurance. B. Life insurance. C. Homeowners insurance. D. Auto insurance. Answer: B. Life insurance. Explanation: life insurance is a non-indemnity policy because it does not reimburse the insured for losses or expenses, but instead provides a lump sum payment to the beneficiary upon the insured's death. In contrast, indemnity policies such as health insurance or auto insurance reimburse the policyholder for actual financial losses incurred due to illness, injury, or damage to property. Life insurance follows the principle of a fixed benefit amount unrelated to the actual financial loss. Question 2. Samantha is a licensed insurance producer in Utah. She has a client, Mr. Adams, who wants to purchase a health insurance policy that includes coverage for a specific treatment. However, after reviewing the policy, Samantha notices that the treatment is excluded under the plan's conditions. Mr. Adams insists on purchasing the policy and requests that the exclusion be removed. What should Samantha do in this situation? A. Agree to remove the exclusion and sell the policy to Mr. Adams. B. Suggest that Mr. Adams purchase a different policy that does cover the treatment. C. Advise Mr. Adams to falsify the application to reflect the coverage. D. Proceed with the sale and note the exclusion in the policy endorsement. Answer: B. Suggest that Mr. Adams purchase a different policy that does cover the treatment. Explanation: as an insurance producer in Utah, Samantha must adhere to ethical and legal standards set forth by the Utah Department of Insurance. If a specific treatment is excluded from the policy, Samantha cannot remove the exclusion or misrepresent the coverage. Instead, she should recommend an alternative policy that offers the desired coverage. Misrepresentation of policy terms, including falsifying the application, is unethical and a violation of Utah insurance regulations. Question 3. Which of the following is not a typical element considered during the underwriting process? A. Insured's medical history. B. Insurance premium rates. C. The applicant's occupation and hobbies. D. The insured's financial goals. Answer: D. The insured's financial goals. Explanation: underwriting focuses on evaluating the risk associated with an applicant based on factors such as their medical history, occupation, hobbies, and lifestyle. These elements help determine the applicant's eligibility for coverage and appropriate premium rates. However, the insured's financial goals are not typically considered in the underwriting process as they do not directly influence the assessment of risk. Instead, financial goals are relevant when determining the appropriate coverage types or amounts for the client. Question 4. Which of the following best describes an insurance policy provision that outlines the circumstances under which a policy can be terminated? A. Endorsement. B. Cancellation clause. C. Insuring agreement. D. Underwriting guidelines. Answer: B. Cancellation clause. Explanation: the cancellation clause in an insurance policy specifies the conditions under which the insurer or the policyholder can terminate the policy. This includes reasons such as non-payment of premiums, fraud, or a material change in risk. The endorsement refers to an amendment to the policy, while the insuring agreement outlines the coverage offered. Underwriting guidelines are used to assess risk when issuing the policy, not when it is terminated. Question 5. Which of the following is an example of a risk management technique where an individual transfers the risk to another party? A. Avoidance. B. Retention. C. Sharing. D. Transfer. Answer: D. Transfer. Explanation: risk transfer involves shifting the responsibility for a potential loss to another party, typically through insurance. By purchasing insurance, the insured transfers the financial risk of certain losses to the insurer. Avoidance involves eliminating the risk altogether. Retention means accepting the risk and bearing the loss if it occurs, and sharing involves distributing the risk among multiple parties, such as in a group insurance policy. Question 6. When an insurer cancels a policy before the expiration date, what must the insurer provide to the policyholder? A. A full refund of premiums paid. B. A notice of cancellation specifying the reason. C. A grace period of 30 days. D. A notice of renewal. Answer: B. A notice of cancellation specifying the reason. Explanation: If an insurer cancels a policy before the expiration date, the insurer must provide a written notice to the policyholder outlining the reason for the cancellation and the effective date. This notice allows the insured to seek alternative coverage if necessary. A full refund of premiums may not be required unless stated in the policy, and a grace period applies only to non-payment of premiums, not cancellation. Renewal notices are sent when a policy is nearing its expiration, not when it is being cancelled. Question 7. Which of the following is true regarding an agent's fiduciary duty? A. The agent must prioritize their own financial interests in handling client funds. B. The agent is not required to disclose their commission to the client. C. The agent must handle the client's funds with honesty and integrity. D. The agent can retain any unearned premiums for their personal use. Answer. C. The agent must handle the client's funds with honesty and integrity. Explanation. An agent's fiduciary duty requires them to act in the best interests of their clients, especially regarding the handling of client funds. The agent must manage client funds honestly and transparently, ensuring that premiums are paid to the insurer and commissions are disclosed as required. Prioritizing personal financial interests or retaining unearned premiums for personal use violates the fiduciary duty and is subject to legal consequences. Question 8. Which of the following statements best describes the concept of adverse selection? A. The insurer's decision to raise premiums based on the insured's claims history. B. The tendency of high-risk individuals to purchase insurance more often than low-risk individuals. C. The process by which an insurer selects agents to sell policies. D. The underwriting process where insurers decide the premium rate based on the applicant's income level. Answer. B. The tendency of high-risk individuals to purchase insurance more often than low-risk individuals. Explanation. Adverse selection occurs when individuals who are at a higher risk of loss are more likely to purchase insurance, while those at low risk are less likely to do so. This can result in an unbalanced risk pool for the insurer, leading to higher overall costs. To mitigate adverse selection, insurers may use underwriting criteria to evaluate and classify risks appropriately. Raising premiums based on claims history is a form of risk adjustment, but it is not adverse selection. The selection of agents is unrelated to adverse selection. Question 9. Which of the following is an exclusion commonly found in many health insurance policies? A. Routine checkups and preventative care. B. Pregnancy and childbirth. C. Cosmetic surgery not medically necessary. D. Emergency room visits. Answer. C. Cosmetic surgery not medically necessary. Explanation. Many health insurance policies exclude cosmetic surgery that is not medically necessary. This includes procedures done for aesthetic reasons rather than for the treatment of a medical condition. Routine checkups, pregnancy and childbirth, and emergency room visits are typically covered under health insurance policies, depending on the terms and conditions. However, exclusions such as cosmetic procedures are meant to limit coverage for non-essential services. Question 10. What is the primary difference between a named peril and more risk insurance policy? A named peril policy covers all risks, while a more risk policy covers only named risks. B. A named peril policy covers specific risks listed in the policy, while a more risk policy covers any risk except exclusions. C. A named peril policy provides coverage for property, while a more risk policy only covers liability. D. There is no difference. The terms are used interchangeably. Answer. B. A named peril policy covers specific risks listed in the policy, while an all risk policy covers any risk except exclusions. Explanation. A named peril policy lists the specific risks, perils that are covered, and coverage is only provided if the loss results from one of those named perils. An all risk policy, on the other hand, provides broader coverage, covering all risks except those specifically excluded in the policy. This makes all risk policies more comprehensive, but they typically come at a higher premium than named peril policies. The terms are not interchangeable, as they refer to distinct types of coverage. Question 11. Which of the following is an example of an insurance policy condition that might limit or restrict coverage? A. Insuring agreement. B. Exclusion clause. C. Premium payment. D. Declarations page. Answer. B. Exclusion clause. Explanation. An exclusion clause specifies certain situations or risks that are not covered under the policy. This helps the insurer limit their liability by explicitly outlining circumstances under which the policy will not pay. The insuring agreement provides the broad coverage terms. The premium payment condition outlines how and when premiums must be paid, and the declarations page lists the policy's basic details, but none of these are intended to limit coverage like an exclusion clause does. Question 12. Which of the following is a characteristic of uninsured motorist coverage? A. It covers damages caused by an insured driver's negligence. B. It applies to damages caused by driver without insurance or with insufficient coverage. C. It is mandatory in all states for all drivers to purchase. D. It only covers damage to the insured's vehicle, not medical expenses. Answer. B. It applies to damages caused by a driver without insurance or with insufficient coverage. Explanation. Uninsured motorist coverage is designed to protect the policyholder if they are involved in an accident with the driver who either does not have insurance or does not have enough coverage to pay for the damages. It may cover both vehicle damage and medical expenses. This type of coverage is not mandatory in all states, though some require it. It extends beyond just vehicle damage to also include medical expenses for the insured and their passengers. Question 13. Mr. Davis has a homeowner's insurance policy. His home sustains water damage due to a burst pipe, but the policy excludes damage caused by water backup from a sewer. What should Mr. Davis do in this situation? A. File a claim for the full cost of repair, as water damage is generally covered. B. Pay for the repair himself, since water backup is excluded under the policy. C. File a claim for water damage and request that the insurer waive the exclusion for this particular incident. D. File a claim for the repair but exclude the water damage from the backup. Answer. B. Pay for the repair himself, since water backup is excluded under the policy. Explanation. In this situation, the exclusion for water damage due to backup from a sewer would prevent the insurer from covering the costs of the repair related to that specific cause of loss. Therefore, Mr. Davis would need to pay for the repair himself. The insurance policy would only cover water damage that is explicitly not excluded under the policy terms, and typically exclusions are enforceable unless a rider or endorsement is added to modify coverage. Question 14. Which of the following is a primary reason why an insurance company might cancel a policy during its term? A. The policyholder files too many claims in a short period of time. B. The policyholder requests an increase in their coverage. C. The policyholder is notified of an increase in premiums. D. The policyholder files a claim for a minor accident. Answer A. The policyholder files too many claims in a short period of time. Explanation. Insurance companies may cancel a policy if the policyholder files too many claims within a short period, as this indicates a high-risk profile. Insurers might consider this behavior as increasing their exposure to loss, prompting them to reassess the risk and potentially cancel the policy. Requests for coverage increases or premium notifications typically do not result in cancellations as long as the premiums are paid. Question 15. Which of the following best describes moral hazard? A. The tendency of insured individuals to take more risks because they have insurance coverage. B. A situation where an individual is more likely to file fraudulent claims because they have insurance. C. The use of unlicensed agents to sell insurance policies to increase commissions. D. The probability that an insured individual will never need to use their policy. Answer A. The tendency of insured individuals to take more risks because they have insurance coverage. Explanation. Moral hazard refers to the situation where an individual may take on more risk because they are insured and do not bear the full cost of the loss. This leads to an increased likelihood of risky behavior, such as careless driving or failing to properly maintain property, as the financial burden of the loss is reduced by the insurance policy. It is not related to fraud or using unlicensed agents. Question 16. Which of the following is a key responsibility of an insurance producer in Utah? A. Determining the insurer's financial stability. B. Designing insurance policies for companies. C. Collecting premiums and forwarding them to insurers. D. Issuing insurance policies to policyholders. Answer. C. Collecting premiums and forwarding them to insurers. Explanation. Insurance producers are responsible for collecting premiums from clients and forwarding those premiums to the insurer. They act as intermediaries between the insurer and the insured. While producers may help clients choose policies, they do not design insurance policies, nor are they directly responsible for issuing policies or determining the insurer's financial stability. Question 17. Which of the following is a factor that may affect an insurance premium? A. The applicant's driving history. B. The applicant's personal preferences for types of coverage. C. The insurer's ethical standards. D. The applicant's employment history. Answer A. The applicant's driving history. Explanation: an applicant's driving history can significantly affect the premium for auto insurance. If the individual has a history of traffic violations or accidents, the insurer may classify them as a higher risk, which will lead to higher premiums. While an applicant's preferences for coverage types will influence the premium, personal preferences are not a determining factor on their own. Ethical standards of the insurer do not directly affect premiums, and employment history generally has no effect on auto or other insurance premiums. Question 18. Which of the following is true regarding a life insurance rider? It adds additional exclusions to the policy. B. It modifies or adds coverage to a standard policy. C. It terminates the policy under certain conditions. D. It automatically reduces the death benefit of the policy. Answer B. It modifies or adds coverage to a standard policy. Explanation: a life insurance rider is an addition to the basic life insurance policy that modifies or adds coverage. For example, a term rider may allow for additional coverage for a limited time, or a waiver of premium rider might allow the insured to stop paying premiums if they become disabled. Riders generally enhance the policy's coverage options or benefits rather than reducing or terminating coverage. Question 19. What is the primary purpose of underwriting in the insurance process? A. To determine the insurance premium rate. B. To advertise the insurance policy to potential clients. C. To decide whether to accept or reject an applicant based on risk. D. To assess the amount of coverage required by the policyholder. Answer C. To decide whether to accept or reject an applicant based on risk. Explanation: underwriting is the process of evaluating the risks associated with an applicant and deciding whether to offer them insurance, as well as what terms and premiums to offer. Underwriters assess various factors such as health, driving history, and lifestyle, and they use this information to determine the applicant's risk level. The decision of acceptance or rejection is based on this risk assessment, and the underwriting process helps insurers maintain financially sound portfolio. Question 20. Which of the following best describes a subrogation in insurance? Say, the process by which an insurer makes an initial claim payment to the policyholder. B. The insurer's right to recover the amount of a claim from a third party who caused the loss. C. The clause in a policy that limits coverage for certain risks. D. The act of an insurer renewing an insurance policy for an insured. Answer B. The insurer's right to recover the amount of a claim from a third party who caused the loss. Explanation: subrogation allows the insurer to recover the amount it paid out on a claim from the responsible third party. This process ensures that the financial burden of the loss is ultimately borne by the party who is at fault, not the insurer or the insured. It prevents the insured from being compensated twice and protects the insurer from unnecessary costs. Question 21. Which of the following is an example of an insurance policy? An endorsement. A. A legal document that cancels the insurance policy. B. A modification or addition to the existing policy terms. C. A clause that excludes certain risks from coverage. D. A payment made by the insurer to the policyholder after a claim. Answer B. A modification or addition to the existing policy terms. Explanation: an endorsement is a change or addition to an existing insurance policy that alters the original terms. It could increase or decrease coverage, add new coverage, or modify certain conditions of the policy. This differs from a cancellation notice, an exclusion clause, or a claim payment. Question 22. What is the purpose of the coinsurance cause-inner property insurance policy? A. To share the cost of repairs between the insurer and the insured if the policy limit is insufficient. B. To reduce the amount of the premium paid by the insured. C. To define the specific risks covered under the policy. D. To increase the total policy payout after a claim. Answer A. To share the cost of repairs between the insurer and the insured if the policy limit is insufficient. Explanation: coinsurance is a cause-inner property insurance policy that requires the policyholder to maintain a certain percentage of the property's value as coverage. If the insured's coverage is less than the required amount, they may have to share part of the cost of any loss in proportion to the shortfall in coverage. Question 23. Which of the following statements is true regarding an exclusion in an insurance policy? A. Exclusions expand the coverage provided by the policy. B. Exclusions list risks that are not covered by the policy. C. Exclusions are added by the insurer at the policyholder's request. D. Exclusions automatically adjust the premium amount based on risk. Answer B. Exclusions list risks that are not covered by the policy. Explanation: exclusions are specific situations, conditions, or risks that the insurance policy will not cover. These are written into the policy to limit the insurer's liability for certain types of losses, such as war damage or pre-existing conditions. Exclusions do not expand coverage or adjust premiums, and they narrow the scope of coverage. Question 24. In which of the following scenarios would a comprehensive coverage in an auto insurance policy apply? The car is damaged in a collision with another vehicle. B. The car is stolen or damaged by vandalism. C. The car is involved in a hit-and-run accident. D. The car's engine fails due to mechanical issues. Answer B. The car is stolen or damaged by vandalism. Explanation: comprehensive coverage in auto insurance protects against damage to the vehicle that is not caused by a collision. This includes damage from events such as theft, vandalism, natural disasters, or hitting an animal. Collision coverage, on the other hand, applies when the vehicle is damaged in a crash with another vehicle or object. Question 25. Which of the following is a common type of insurance fraud? A. Failing to pay premiums on time. B. Lying about the value of property when filing a claim. C. Signing an insurance policy without understanding the terms. D. Buying insurance to cover a pre-existing condition. Answer B. Lying about the value of property when filing a claim. Explanation: insurance fraud occurs when a policyholder provides false information to the insurer, usually to receive more money from a claim. Common forms of fraud include inflating the value of lost or damaged property, misrepresenting the circumstances of an accident, or filing a false claim altogether. Question 26. Which of the following is an example of a named perils insurance policy? A homeowner's insurance policy that covers damage from all causes except for those specifically excluded. B. A life insurance policy that provides a fixed payout in the event of death from any cause. C. An auto insurance policy that lists specific causes of damage covered, such as fire, theft, and hail. D. A health insurance policy that covers all medical expenses except for elective surgeries. Answer C. An auto insurance policy that lists specific causes of damage covered, such as fire, theft, and hail. Explanation: a named perils policy specifies exactly which risks or perils are covered. In this case, the auto insurance policy would list specific risks like fire, theft, or hail. In contrast, an all-risk policy covers all risks except those that are specifically excluded. Question 27. Which of the following is an example of replacement cost coverage in a property insurance policy? A. The insurer pays the actual cash value of the property at the time of the loss. B. The insurer pays the replacement value of the property without any deduction for depreciation. C. The insurer pays the minimum amount required to repair or replace the property. D. The insurer does not pay for property damage caused by natural disasters. Answer B. The insurer pays the replacement value of the property without any deduction for depreciation. Explanation: replacement cost coverage means that the insurer will pay the cost to replace damaged or destroyed property with new property of similar kind and quality, without accounting for depreciation. This is different from actual cash value, which would deduct depreciation from the replacement value. Question 20. Which of the following types of insurance would typically cover medical expenses resulting from an accidental injury at work? A. Workers' compensation insurance. B. Disability insurance. C. Auto insurance. D. Health insurance. Answer A. Workers' compensation insurance. Explanation: workers' compensation insurance is specifically designed to cover medical expenses, lost wages, and rehabilitation costs for employees who are injured while working. It is mandated by law in many states for employers to provide this type of coverage. Disability insurance generally covers income replacement for individuals who are unable to work due to injury or illness, but it does not cover medical expenses related to work injuries. Question 29. Which of the following would be covered under a standard flood insurance policy? A. Flood damage to a car parked in a garage. B. Flood damage to a primary residence. C. Damage caused by a sewer backup during a storm. D. Damage to an outdoor swimming pool during a flood. Answer B. Flood damage to a primary residence. Explanation: a standard flood insurance policy typically covers damage to a primary residents due to flooding, such as from heavy rain or rising waters. However, it usually does not cover damage to cars, sewer backups, unless specifically covered or outdoor structures like swimming pools. Question 30. Which of the following statements best describes the principle of indemnity in insurance? A. The insurer will pay only the minimum required amount for any loss. B. The insured should not profit from their insurance coverage. C. The insurer pays the full market value of the property in all cases. D. The insured is entitled to a payout equal to the premium they paid. Answer B. The insured should not profit from their insurance coverage. Explanation. The principle of indemnity states that insurance is designed to restore the policyholder to the same financial position they were in before the loss, but not to allow them to profit from the loss. This means that the payout should cover the actual value of the loss, but not exceed the value of the insured property or cause the policyholder to make a profit from the claim.